So thank you very much, Heinz. I think that was an incredible session. How did you find it? Great session. Thank you so much. Really greatly appreciated. So without further ado, we talked about this morning some of the key challenges. One was we talked about marketing, and one of the key challenges we spoke about was also access to finance or funding. So we're at NatWest head office, so let's introduce NatWest to talk about funding.
Hi everyone, I'm Shania Ferdinand, and I forgot I'm also supposed to control the slides as well as talking at the same time. So thank you. For anyone who can't multitask like I can't, this is going to be probably quite familiar. So I'm Shania Ferdinand, Enterprise Community Strategy Director, and essentially what my role involves is partnering with amazing organisations like the UK Black Business Entrepreneurs Conference to put on events like this to help bring, information to business owners, particularly those from ethnically diverse backgrounds. I'm joined today by some people from my team, so give us a little wave. We've got Shatter at the back, Layla to the left, and my glamorous assistant here, Nick Howe, who many of you will know. And if any of you ask me any really tricky questions, he's prepped to answer them all. So as working for a bank, we often get asked about funding, and sometimes we get asked questions that we will recognise actually are very particular to types of funding that we don't actually offer. So today what I want to do is give an overview of the different types of funding that there are, what we as an organisation or as a bank or banks actually offer, but also just give you an insight into what are some of the key considerations or some of the questions that we will ask and why, as well as giving a perspective of what investors will look for as well, because I think it's really important to, when you're preparing to take money into your business, to kind of understand what is it that I need to know so that I can essentially set the scene or pitch this at the right space in order to help me to communicate what it is I need and what I want, and also help to decide, is this actually the right type of funding for me and my business? So just a few, overview of that and a few key things to think about. So first of all, I'm going to start off with bank funding. So before I go any further, has anyone taken out any funding? Not specifically from a bank, just in general. Has anyone taken external funding for their business? Not many of you. Okay. And for those who haven't, is there anything in particular that has stopped you, or why you haven't done that as yet? Going through too many hoops, okay. Information, in what sense? Access to information, okay. Anything else? Oh, yeah?
I was going to say, what I found, why I did not go directly to bank funding, is there's a lot more red tape. It also forces me to stop and actually examine what I'm doing a lot more before going to the bank.
Which I think is, really important. I think, obviously, there are things that, like I said, you will need to consider and questions that will be asked of you, but actually it is so important when you're thinking about taking in any type of funding. What will this allow me to do? What is the reason that I'm doing this? And what are, some of the contingencies that I might need to put in place? So, first slide. Heinz already said it, working capital is so important. Who knows the famous phrase? Shout it out at me. They say cash is king, but actually I think cash is queen, because obviously we know the queens are the most important people in the room. But ultimately, as an organisation or as a bank, working capital is something that we can support with. But for any business owner, working capital or cash and knowing where your cash is one of the key things that you need to understand. So in terms of, savings, a lot of business owners will bootstrap, or will start off thinking about, who do I know, who are my friends, who are my family. FFF, I found out recently, is friends, family and fools. I don't know who these fools are, but but that's a way that people start off thinking about funding their business. And bootstrapping is something that I think is quite popular, and there are many benefits to it, making sure that you have control over your business, you're able to plot ahead, but some of the considerations or some of the things it might not allow you to do is actually grow fast or be able to fulfill something. So, if, for instance, if you were to get a massive order, not only bootstrapping means that you're not necessarily able to move as quickly as you may like to, if other than getting external funding that will help you to grow faster. So another way that a bank can help with working capital is a business overdraft. So an overdraft essentially is an extra amount of money that's connected to your account that you're able to dip in and out of throughout a monthly cycle. So with a business overdraft, we tend to think about those in terms of short-term borrowing. So it's more for like that day-to-day cash management. Maybe you have a thing that you need to pay for that's going to take you slightly over what you currently have in your account. But the intention is that actually we will be able to repay that overdraft relatively quickly. They're not intended to be used for sort of like long-term or necessarily large purchases. And I guess some of the pros of going for or looking at overdrafts is they're, in comparison to other types of funding or larger types of funding, they're relatively easy, more easily accessible than some other types of funding to have. But I guess the things to consider with an overdraft is if poorly managed, they can be or asked to be recalled at any time. So that is something to sort of always be aware of. And also not necessarily think about an overdraft as a long-term plan in terms of funding. The third way that we sort of, again, would be able to support, or a bank would be able to support with working capital or cash flow is by the utilisation of a business credit card. So business credit cards, again, people tend to use them for day-to-day spending. What's great about a business credit card, again, is they can be fairly easily accessible. They're great to be able to keep your business finances separate from your personal finances. And they also, with credit cards, they can also help you to improve your credit profile as well. Being able to, again, managing a credit card well can help you to improve your credit profile or give a picture of a credit profile, which then can be really beneficial when it comes to looking at other types of funding or larger types of funding. Nick, is there anything I've missed so far or anything you want to add?
Just two things. First of all, roughly speaking, about half of our entire customer base has some sort of funding and finance. So therefore, the other half don't. So the perception often, I'm running a business, therefore I need funding. That's not always the case. The second point as well I'd make is around working capital. This is the aspect of funding that trips more businesses up than anyone else. And it's essentially, as kind of just to build on what Shani has said, it's bridging the gap between when we as a business have to pay money out versus when we are expecting that money to come in. So if we're expecting an invoice to be paid next week, happy days if it comes in, but if it doesn't, does that mean we can pay the rent, the rates, the utility bills or whatever? If not, we've got to try and find that money from somewhere. So bootstrapping I'm a massive fan of as well in addition as well, because when you have the money, very much like my man said earlier really, when you have the money, you are probably a little bit, freer, and you'll spend the money on this. We could all spend the money. When you are bootstrapping, you're really taking a real deep look as to, if I spend this little bit of money, where can I get the best return for it? So I think that's worth acknowledging.
Thank you. And Nick sat down, but I'm probably going to get him up to talk about something else in a second. But another way to another area that might help with working capital and also really links to bootstrapping is what we call sweat equity, where we use, rather than paying for services, we're able to kind of like utilise the expertise of those around us. And that, I think, one of the key things that we've learned and we advocate along our journey in terms of supporting business owners is how priceless a network or a really great network can be, in being able to connect with other business owners, being able to share expertise, being able to call in the family, in other words, to really be able to help you to really streamline how much money that is going out the door, and again really supports that working capital piece. So the next thing I guess I would like to talk about a bit more is more of that longer term borrowing. So those that I mentioned earlier were probably more short term, but in terms of longer term borrowing, from a bank perspective, we're looking at loans. So business loans, I guess, every type of funding has pros and cons or has benefits and things to consider. And when it comes to business loans, I guess one of the great things about them is that in theory you would be able to borrow a larger amount of money than you would than if you're just relying on a credit card or relying on an overdraft. One of the other benefits of a loan over other types of forms of money is you're actually able to really, I guess, monitor and plot what expenditure is going to be coming out like month on month. There's a set interest rate, which compared to, some forms of finance is not as high as others. They can be variable, and it is really dependent on your sort of personal circumstances. But I guess the benefits are, if I'm borrowing £1,000 and I'm borrowing that over the course of 10 months, I'm paying back, I don't know, I'm making the numbers up, but like £112 a month. So you can kind of like plan for that and make sure that you have that money every month. I guess some of the considerations or the things to think about with a business loan is it's not always the most accessible, especially larger amounts of loans. And we also, some of the things or questions that come up to me or things that put people off is this aspect of thinking about security when it comes to a loan. So I don't know if everyone knows the difference between a secured loan and an unsecured loan. No, I'm seeing some nods and some head shakes. So essentially, an unsecured loan is when we will lend you money over a specific period of time. You'll pay back that money every month, but we won't expect ultimately any kind of guarantee or another form of security or guarantee to say if you aren't able to pay this money back, then we're using this asset in a sense as security. Whereas with a secured loan, it's something that we would ultimately, if you're borrowing a larger amount of money, we would look at typically if you weren't able to pay back £500,000, say, you were borrowing £500,000 from us and you get to the point where you're not able to pay that back, before we get to that point, we'd ultimately take out what we call security. So we'd look at, do you have an asset that if you are unable to pay all of that money back, we would take a security over that to say that in the event that you can't, we would utilise that as a form of security. I guess some of the things to consider with regards to utilising security or things to know is we don't do secured lending for anything under £50,000 currently. Different banks may have different limits, but ultimately you can get unsecured lending up to a certain amount. However, if you are needing a larger amount, it is something that you may need to think about or may need to consider before you would want to approach the bank. Obviously, not everyone necessarily has an asset they could use, but it is something that for a large amount of money we would look for. But also there are guarantee schemes and things that we can talk through and talk about, again, depending on your individual circumstances. Sorry, I'm trying to think if there's anything else I wanted to say before I move on. Yeah, please do.
I just got a couple of things to say on that. Right, who owns their own house? You've done ever so well. I mean, it's just property values are so high at the moment, particularly younger businesses, newer businesses coming on. So very much like Shani has mentioned, the availability of security isn't always there. And I do not want that to be a blocker for your ambitions, for your ideas. Shania also mentioned one of the guarantee schemes, the Enterprise Finance Guarantee Scheme, is a scheme that the government operates, which works in comparison with all the banks, all the financial institutions. And if there were an instance, if there were a situation where we wanted to support a founder with their borrowing request, and the only thing that's missing is the lack of available security, i.e., not enough equity in a property, then that's where for most industries, most sectors, we can tap into the Enterprise Finance Guarantee Scheme. So I don't want people sort of thinking, I'm going to ask for a big amount of money, I don't have enough security, and therefore my road is closed. That is not necessarily the case, so definitely have a conversation. The second thing I just want to mention around that key word there is affordability. We make no apology for trying to make sure that if you are borrowing money, that we try as best we possibly can to make sure it's affordable. Because we have to think, next month when that repayment falls due, is that business going to be able to afford that? That's absolutely the right thing for us to do. Another tip that a founder shared with me on that particular point, quite often the aim of many founders is to borrow the money over as short a possible time so that it costs less in interest, which I totally understand, I totally get. However, if you borrow money over a shorter time frame, the minimum and legal repayment every month is going to be higher. One tip, one idea, is to try and ask the question, how long could I borrow the money over? Can we see if we can stretch it over 5 years, 10 years, or whatever? What would be the maximum? So therefore, even in that quietest month in winter, when there's no customers coming in the shop or coming in the business, we're actually keeping the repayment as low as we can possibly get it. But it's not all about raising the money on the interest side of things. You have full flexibility with most types of loans these days to overpay. So you can actually have the best of both worlds. Get that minimum commitment every month as low as you possibly can have it, but with the flexibility that as and when things go well, you can knock lump sums off the debt and get it repaid as quickly as you want to. So.
Thank you. So another type of finance that banks offer is something called asset finance. So what asset finance is it's, I guess, similar-ish to a loan, is that we are lending money to you, but rather than asking for a type of security that may be unrelated to what it is you're buying, we may look to take security in the form of the asset. So, for instance, you're a florist and you want to buy a van so that you can start making deliveries. And these deliveries mean that you're going to be able to increase your sales and increase your profits. But you don't have the money to buy the van. So, through our asset finance offering, we will lend you the money to buy the van, but then we would utilise the van, for instance, as the form of security that if you, in the unlikely event you're unable to pay, we're then able to utilise that as security. We also offer a form of finance called invoice finance. So invoice finance is when Tesco at the back of the room are going to stock your incredible product, but how these work is invoices don't tend to get paid straight away. So some retailers will do 30-day terms, some do 60, some do 90-day terms. And in the interim, in between you giving them your goods and you actually getting that invoice paid, you have a cash shortfall because that money is still waiting to be paid. So how invoice finance works is there are two different types. So there's invoice factoring and then there's invoice discounting. So invoice factoring is when, based on the invoice, you have an invoice for, again, £1,000. We do factoring, so we will then give you £900 of that £1,000. And from a factoring perspective, as an organisation, we then chase the debt. So we will then talk directly with Tesco and say, OK, you now owe us £1,000. And once we get that money in, you'll get the remainder minus the fees that we charge. Invoice discounting is a similar thing, except rather than us managing the, chasing the payment, essentially, you as the business owner would do that yourselves, which then means it's you're paying slightly less in terms of fees, but either way you're able to get some of that money or get that cash and working capital in the interim, in between you sending the goods to the retailer and you actually receiving the funds. And I guess another form of funding or finance that banks can look to support with is in trade finance. So are there any international businesses or businesses that are trading globally in the room? So with trade finance, essentially what that is it's an ability to support you with some of those additional costs that come up with trading internationally. So, things like shipping costs, being able to work with suppliers on the ground in other countries, and extending lines of credit. So there are different ways that we can support, because that, when you're trading internationally, that can come with a lot of additional costs. And I guess when you're thinking about trading globally or trading internationally, the Department for Business and Trade are a great source of information. There's also UK Export Finance, who also, again, provide information on ways to start trading globally. Department for Business and Trade actually helps small businesses and are looking to do more with different communities to be able to help them to expand into global markets as well. So they're really a great source of information. And then finally, another I guess another type of borrowing that we offer is what we call venture debt. So venture debt is for what we would call high growth businesses. So high growth business typically is a business that's going to grow 20% year on year, and those businesses tend to be very attractive to sort of investors because they've created some kind of like amazing solution that everybody's going to want to buy. But businesses, particularly innovative businesses or that maybe have a tech-based solution, tend to go through quite a period of what they call pre-revenue. So it's like we have a model, we might have IP, we know we're going to make loads of money in 2 years' time, but right now we're not making any money because we don't actually physically have a product to sell. So how venture debt works is it kind of works alongside getting that investment, but ultimately when you are pre-revenue, if you're this type of business and you're pre-revenue, we're able to lend money based on the fact that you will be making money in sort of the short medium term, so 1 year to 2 years time. And again, it works like a loan, but it will be for largely a larger amount of money, or a larger amount. And also it, rather than the repayments with most loans will start kind of like within a month or so, venture debt, the repayments would start at the point that you're actually generating revenue. So it's just a bit more flexible than, I guess, a standard business loan, but it is for very specific types of business. So in terms of long-term borrowing, I guess Nick did cover quite a bit of it, but I guess some of the things that banks consider or the things to think about are security, as we mentioned. Again, that would be for really large amounts of money, so it's not applicable to everybody. The length of borrowing, so we as an organisation from a business loan perspective will lend for 7 years, I think is the max term. So again, if you're lending for a longer amount of time, it does mean that your monthly repayments will be lower, and as Nick said, you can absolutely overpay if actually you're like, there's more money coming in than I expected. But what it does is it just gives you that guarantee that I know exactly how much money is going out each month, which I think in some ways can give you a bit more freedom than some other types of funding when you know exactly what's going out. We will really look at affordability. Oh. we will really look at affordability. That's a really key thing that banks consider. And so if you are looking to go for lending, one of the things you might want to do in anticipation of that is actually work out, if I were to borrow £5,000 and I were to spread that over 5 years, this is what the monthly repayment would be without interest. If I then add on 6% interest, 7, 8, 9, 10% interest, it can just get you in the mindset of, okay, this is how much that loan is likely to be. And one thing we will do is we'll go through what we call income and expenditure. So we would look at everything that's coming in, everything that's going out, and that money, that amount that's left over needs to make sure it's covering what the loan repayment would be almost 2 times. So essentially, if the loan repayment's going to be £100, you almost need to know I'm going to have at least £200 spare, because what we don't want to do is almost leave you with no leeway because other expenses and expenditure might come up. So that's one of the biggest things when it comes to lending that we really do look at is affordability. And then the final thing is just around like credit rating and credit history. So again, there are Equifax, and there's another one that's now gone out of my head.
Experian.
Thank you. You can go to them and look at, get a picture of your credit rating. And if you are, and this isn't me advertising NatWest because I'm just not sure if other banks do it as well, but if you are a NatWest customer on our banking app, you can now every month, it will pop up with have a look at your credit rating. So again, if you want to have an idea before you even look at lending whether you're likely to sort of meet the criteria, you can kind of get a picture of, would my credit rating, is it in a position where I'm likely to be accepted or rejected? Anything to add, glamorous assistant?
I would just add, actually, from a perspective, I was just shocked by Shania's brand ambassador. You're wearing a NatWest purple. So accident, I'm not. But just around trade finance, actually, this is also an area where, from your perspective, you can start to perhaps bring some of the risks down. So one example might be a letter of credit, which is where, let's say you've had some samples from a supplier in, let's say, Singapore, right? Very happy with the samples. You've now had your first order. Happy days. You need to order £8,000 worth of garments from Singapore. It's a little bit of a stalemate. Do I send the £8,000 halfway around the world in the hope that those products are going to turn up exactly as I've ordered? And by the same token, the supplier in Singapore is thinking, well, if we make these and ship them halfway around the world, are we going to get the money? So there's a little bit of a stalemate. What a letter of credit potentially does, as if we were your bankers here in the UK, we would work with the suppliers' bankers in Singapore, and we'd be able to say, we are holding to order the sum of £8,000 as long as we get the shipment in terms of the right quality, quantity, size, shape, colour, whatever it is that we've ordered. As long as that turns up as expected, then we will release the £8,000. So it is an example of where, you know, from a business point of view, you may be able to bring some of the risks down that otherwise you might face.
Thank you. So moving on to what is it we'll actually ask for when you approach us for lending. So again, most of our loans or lending is now done digitally. So if you're lending up to, asking for unsecured lending up to £50,000, that will be done online. But some of the questions that we ask will be encompassed within, I guess, a traditional business plan. So some of the key things that you again want to think about the best ways to communicate these is, who is the management team? Is it just you? What experience do they have? Why do we know that you're going to be able to essentially make this business a success, make this additional money and be able to pay us back? We'll also look at what is the product and service. So what does the business actually do? Sorry, I'm jumping ahead a bit, so I was about to say, who is your customer? Who's your target market? How do you communicate with them? But ultimately really define who your customer is, so that we, again, from our perspective, we know that you have done your research and you understand who it is you're selling to and how you're going to reach them. And as Heinz talked about earlier, in terms of what channels you're also going down, whether it's social media or other ways to speak to your customers, which really links into kind of marketing your business and how you're communicating with the customers. Another area that we would potentially look at, or for you to think about, is that competitor analysis. So who else is out there doing similar to what you're doing? What are they doing really great that you can emulate, and what are they doing maybe not so well that you can avoid or mitigate for or make better? And how is it that you are kind of, I guess, avoiding some of the pitfalls of other business owners? Oh, that's actually me, sorry. No one ever calls me and then they call me in the middle of the day like they don't know I have a job. Thank you for being with me. I heard felt this vibrating. Lost my train of thought now. So the next thing is operations and logistics. So what are your operations? How, again, are you getting your product or your service out to your customers? What is your route to market and all of that stuff? Pricing strategy, which is really important, and Heinz covered earlier very well, I think, in detail. So I won't try and embarrass myself by saying any more. But again, have you really figured out what your goods or your services cost and why? What have you really factored in the time that it takes specifically, especially if you're a service business? It can be really hard to pitch it well, but actually, what is the cost of your time? What is the cost to deliver this? What are your competitors delivering? And again, is it actually going to, does it cover everything it needs to cover? And is it going to make sure that you're making the money that you need to make in the event that you need to pay for this additional level of borrowing? We will ask for a financial forecast. I'll get Nick to cover that because I know that he loves those. But before we move on to the finances, the other thing just to consider and think about is what we love to call a SWOT. We love an acronym at the bank, but strengths, weaknesses, opportunities or threats. I did this presentation in Birmingham and someone was like, would you look at PESTLE as well? Because they like to bamboozle me. But PESTLE is another form of, I guess, risk management analysis. So some people may have to help me out, but you're looking at political, environmental, not so fast. Did everybody hear all of that? But ultimately, are you able to think about if the worst were to happen? So 4 years ago, I'm sure none of us expected the pandemic, and we know what a massive impact it had on businesses. And had some of us been able to think ahead, or maybe some of us did, but had most of us been able to think, what would we do in that event? We probably would have got up and running a lot faster following the lockdown. So my challenge or suggestion to you is, if an alien invasion were to happen next week, how are you going to make sure your business is still running? Do you know? No. But no, in all seriousness, I think it, from our perspective as a lender, if you're able to say, you know, if this were to happen and I were to lose sales here, actually this is how I'm mitigating. This then helps us to have confidence that you are still going to be able to trade and turn over and make money, and ultimately pay our money back. Anything else to add, Nick?
Yeah, I would just add a common question: how long should a business plan be? There isn't a right answer. Right. The most important thing from our perspective is that this is something that you own, you understand, so you do it in a format that absolutely works for you. One other tip I would say: don't do this too early. There is a precursor to this, which is called the business model canvas. There is a danger if you are very early stage and you think, right, I'm now going to pull my business plan together. A large majority of that may be based on that dream that you had in your head of how your coffee shop looks or how your cosmetic brand looks or whatever. That is a danger because you're putting resource and effort into something that may not be the model, the version of the business that you're going to end up launching. It's not to say that all those aspects are not important, they absolutely are, but the format using a business model canvas allows you that flexibility to say, I mustn't lose sight of what I've got to find out about my customers, about my audience, about my suppliers, but let me do that as I'm going along. So use the business model canvas in the early stages as you're researching, as you're finding out, test trading. But then when you get to that sort of area where things are a little bit more concrete now, that's then the time to sort of plough into the business plan.
Question. Okay. I just on the business model canvas and the lean canvas. If a business produces a high-level lean canvas with their financials, would the bank take that?
Yeah, I think that would certainly, if all the information's there, what it may be just a prompt, because obviously on a business model canvas it is abbreviated. That's very much one of the advantages of it. There may be that devil in the detail that we may need to see. So I don't think on its own it would be a no, absolutely, but it may very likely be, right, you've said you're going to do this in your business model canvas, can we have a bit more data, evidence, statistics, whatever it might be? So.
Yeah. And as I mentioned, for certain amounts of lending, so up to 50,000 where it's unsecured, that is done on an online platform. We're all moving to obviously more of a digital market and communicating digitally. So with regards to that, it's an application form. So ultimately what we're saying is this is the information we're probably going to ask, but it's not a case of you have to send us your business plan. It may be that it's just these are things you're thinking about. So when you're filling in the application form, you can communicate, here's what I've considered, here's what I've done, here's why I know that if you give me this money, it's going to be a success, it's going to grow my business, and then I'm going to be able to generate more turnover. So we wouldn't necessarily accept the business model canvas as attach it, but it's just to help you think about what are the key things I need to think about to be able to communicate. And then the financials, which are not my favourite part, but ultimately, as an organisation or as a bank, we are going to be looking quite strongly at these. And I think it's the same with investors, to be fair. So thinking about, have you worked out what you're doing? Have you created a cash flow forecast? Do you know what your cost of goods is? Do you know how much revenue you're getting in? If you are a seasonal business, yes, okay, maybe in the summer months you're making a lot more, but actually have you accounted for those winter months when you're not making as much, and what is that kind of overall annual picture, and how do you communicate that to us? There was something I was going to say and it slipped out my head. Nick, anything to add while I try and remember what I was going to say?
I would just share, again, founders' stories, because you learn so much from founders. So I had a lady wanted to launch a coffee shop. This sounds mad, but she spent a whole day on a camp chair outside or opposite the road of where her empty shop was going to be. She was counting the number of people passed by, right? The reason she did it, she worked out the fixed costs of running her coffee shop. So she knew the rent, the rates, the utility costs, everything that was going to be paid out, whether she had one customer or 1,000 customers. She knew month in, month out, that's what was going to have to be paid out of the business. She also knew that every time she sold a cup of coffee, It was a few years ago, so she made £2 per cup of coffee. If you divide the £2 into the total annual fixed costs of running the business, that reveals how many cups of coffee you need to sell that year. She then divided that into each day that she'd be open, so she used 6 days a week, and then that told her every day I need to be serving X number of customers. By clicking and counting how many people passed through the door, the day she was there, it needed 50% of all customers passing to pop in and buy that average cup of coffee. So she decided, in my view, rightly, that was not the right location for her, because 1 in 2 people passing your door, that's kind of not realistic. So they are the levels that you can actually go to. And then another lesson or another sort of suggestion, I'm not a massive fan of this, if I'm honest, in terms of kind of, it gives you a kind of an idea of where we are. The best template that I think you can use is the monthly profit and loss and the monthly cash flow. But don't just use it as it is there. It will tell you month 1 we think we're going to earn this, month 2 we think we're going to pay out that, right? After each month, insert another blank column. That is then where you, as your first action as a business owner, will start to put in the actuals compared to the projected. So you thought you were going to earn, I don't know, £2,000 worth of sales in month 1. Month 1 has now been and gone. How did we do against that? It will either be better than we thought or it will be worse than we thought. But crucially, it gives us a chance to take action in a timely way and either make more of the opportunity or to step in and address a potential problem before it becomes a massive one. So.
Thank you. And I did thank you because I actually remembered what else it was I wanted to say. And it's that, I'll come to you in a second. It's that not all of us love financials and finances and working out how much is coming in and how much is going out. What does this cost? What does that mean? But actually, even if you choose to work with an accountant, one thing that I would really suggest is working in collaboration with them and being very close to them, because ultimately when you are looking for external sources of money, a lot of the time you are going to have to provide this, and you are yourself going to have to be able to talk to what it means and is it realistic, because sometimes accountants will use what they know, but you know your business best. So it's not to say that you have to do it all on your own, but at the same time, if you are working with an accountant, just work very closely with them particularly, or if you have a finance director or something like that, work closely with them so you know what's going on as well. Sorry, Dr. Carlton, you had a question?
Yeah, it was just in terms of operating cash flow. So if you're dealing with just a point of reference really, but if you're working with a particular supplier, a customer you're servicing, some customers pay you on 30 days, some will pay you on 60 days, some will pay you on 90 days, some will pay you reasonably quickly. So in terms of money coming into your business, it's just really, when you're doing your monthly cash flows, it's just important to understand where does your customers pay you, because that will have a significant impact on your cash flow and how you leverage your cash flow. So if someone says, oh, I've got a £30,000 order, but I don't pay you until 60 days, you might have to buy stock in the interim period, so your cash flow is kind of skewed on that basis. So I just think it's really mindful that you understand how your customers are paying you.
100%. Okay, so other types of funding. Investment. Now, I think investment is a very exciting word, and we all want investment, but I think the reality is not every investor can invest in every single business. And so again, I think it's important to think about or understand or start to know what is it that investors consider, or what is it that they want, or what are their mindsets, and especially in comparison to other forms of lending. So there are different types of investors. So you have angel investors who tend to be private individuals who may have extra money, who want to support a business. And angel investors, because they are individuals, what sometimes they will do is they will form syndicates so that they're able to actually pool resources so that they can give a higher level or a bigger level of investment into a particular company. I think with angel investors, one of the key things to think about or note or remember is because they are private individuals, their motivations may be more closely aligned to yours than some other types of investors. And not every single one. Obviously, they want to make money and they want to get a return. But of the angel investors I've met or spoken to, a lot of them are actually really excited by the prospect of supporting a business and helping a business to grow, and particularly if it's in a field or an area where they are themselves passionate or involved in. So that's something to think about and consider. Venture capital is essentially an organisation that is a fund that is created, and it is individuals' money, but the individuals themselves aren't involved in the management of that fund. The fund is managed by fund managers, and so I guess the difference or how that works differently to angel investors is it's more of an organisational piece that you're thinking about. So their motivations are, I guess, more specifically focused on what is the return on investment, how quickly can we get that money back, and how will I be able to make loads of money for my clients that I'm essentially trying to make money for. Corporate venture capital is the same as venture capital, but where it says corporate, it's usually a large organisation that will have its own venture capital fund. So where venture capital is more private equity and private money, corporate venture capital is an organisation like NatWest, for instance, will provide venture capital to individuals. But again, it's managed by fund managers, and it's very much focused on what is the return on investment, at what point will we make that money, and what are a number of businesses that we're investing in. So they're always investing in a really large portfolio. It's never just one business as opposed to an angel investor. And then a family office is essentially usually, again, managed by another firm, or it might be supported by a legal firm, but they're managing wealth on behalf of a wealthy family, for instance. And again, their focus is around how do we increase the wealth or keep wealth for this wealthy organisation or wealthy family. How do we keep increasing that wealth? And again, how do we make smart investments to have a return on money? Anything to add, Nick?
Oh, yes. Right. Angel investors, the best starting point is an organisation called the UK BAA. So it stands for the UK Business Angels Association. Up and down the country, there are angel networks. They're all focused on different types of founders, different sectors, different geographies. That is your good starting point to find out what angel networks exist out there. A point from Michelle's presentation this morning, which is don't wait until you need something from someone. Put them on your radar now. And I think that point from a marketing point of view, from a network point of view, but also from an investor point of view, is really valid. So if you think at some point you're likely to approach investors and want investment as a way of fueling your growth in the future, don't wait until that month before you think you're going to need it. Switch the radar on now. So when you're having conversations, when you bump into people, tell them you're not ready to raise investment right now, but at some point in the future, you absolutely will do. So I think that's important. Secondly, I'm going to add one of the biggest learnings that angels share with us is the tip of don't just ask for money, ask for smart money. What they don't like is they don't like being seen as being sat at the end of the table as a big bag of pound coins. They don't like that. And the reason for that is, but they get excited about business because usually that's where they've made their money. They have got a ton of knowledge, expertise, contacts, experience that really can help you. If they get excited about your venture, your business, they can see they can add that value there as well. But let's remember, it's not just a one-way interview. A lot of founders sometimes, when they get to that stage, they will think, I've got to kind of perform. I've got to get this investor on board. I've got to convince them of my worth and I'm the business to be investing in. Yes, you do have to do that. But please, please don't forget that it's also an interview the other way. What's your gut feel on this person? They may have, like in dating profile, right? They may have the experience, the knowledge, the contact blows your socks off. You know, you sort of think, what a great person to potentially have on our team. But if every month when you catch up, if they leave you with a bit of a feeling that, I just don't look forward to this, it's just the wrong vibe in terms of what we're bringing into the business, then let's sort of think of that as well. And then lastly, I will just mention Black Seed VC is a venture capital organisation that we are proud to partner with. Again, Dr. Carlton mentioned a set of data earlier this morning that as a black female founder, statistically and shockingly, you are more likely to win the lottery than secure funding from a VC based on how the VC industry has been to date. So what Black Seed have done, and one of the reasons for us partnering with them, is they've gone into the VC industry to say, look, come on, this isn't right. What can we do? What's going wrong? Can we bring people together to really focus in on this important issue? And so that's what they're absolutely doing. And part of that is preparing a pipeline, because one of the lessons was that actually, again, there's no point waiting for VC funding when I need it tomorrow. Let's bring that sort of pipeline of talent, that pipeline of possibility, sort of start working on that, say, 18 months out, so that as and when they do get to a point as a founder where they're ready to invest and be invested in, then they've got that shop window, they've got that opportunity. So that's definitely, again, another partnership worth flagging.
Thank you. You had a question?
That we're not doing that can gain us the investment, and also how can we support Black Seed and organisations that actually providing a narrative around what we do and our value, because there seems to be a bit of a blinker around black female founders, and I want to understand why that is, and why we're less likely to be funded or invested.
And I think, I mean, that on its own, that is a topic we could have a whole day on some of the aspects, some of the traits that have featured in that. I totally get that, and I think one of the things that the Black Seed team would say is there is a lack of appreciation, there's a lack of representation within the industry, and that is definitely something that they've challenged the industry with, to say that status quo is not good enough going forward, that needs to be changed. And there are some indications that's starting to sort of take place. One of the things that is important is, for example, the compelling data. So how can we use data better to actually say, for example, the average household, who is the main decision maker in that household? And when you look at different community groups as well, that discretion and that decision making actually goes even higher. So depending on the product, depending on the service that you're actually pitching, then, you know, having that evidence on that data, and we kind of know someone here who's good at data, don't we, Dr. Carlton? So there's a lot of information there. And then I think lastly, when we talk about pipeline building, I think that's also confidence building as well. And I think simplicity is often the way to go. I think approaching different investors at the right place and at the right time is also important. So, for example, if you're reaching out from cold to a potential investor, whether it's an angel investor, whether it's a VC, if that's your first contact, believe it or not, you're not actually asking them for investment on that email. What you're actually asking for is for a further conversation, a coffee or a chat, so that you can discuss that in more detail. And sometimes framing that in terms of the amount of information that we send through and the simplicity of the amount of information that we send through. That can often be the difference between whether they will be the one email that they read on the 50 that they get in their inbox today or not. So, but you know, I don't want to sort of scratch the surface with that, because there is a massive number of needs and areas, and I'm sure, and Dr. Carlton was already talking about what can we do next. So that may well be one of the areas we can explore.
Thank you, Nick. And just to add to that, we're starting to see more organisations that are looking to kind of support businesses from, I guess, diverse backgrounds, because they recognise that we're not doing enough, or not enough money is flowing that way. So that organisations like Black Seed or Cornerstone VC that have been set up specifically by Black individuals that want to invest in Black communities is one aspect of it. There's another organisation that we've had some conversations with called Ethical Equity, who are starting to work more with different communities, again, to encourage people from diverse backgrounds and who are interested in impact investment themselves to actually come together to form these angel syndicates. Because I think a lot of the time people think, oh, I have to be a millionaire, I have to be a billionaire to be able to invest in a business, when actually if you're able to, Ethical Equities point, so that they say you can invest as little as £500, but actually if your £500 is added to other people's, that's where communities can come together. So I think it's also about that. How are we encouraging different individuals to think about the impacts that they can make? And equally, you've got an organisation called Diversity VC who are there starting to hold like the VC sector to account and saying, here's where we need to do better, here are the changes that venture capital firms need to make. So there's so much more that obviously needs to be done, but that conversation is being had, and there are more people focusing on it. And even the Investing in Women Code that was created a few years ago, they're starting to look at how many people from different backgrounds, whether it be Black backgrounds, Asian backgrounds, are actually getting investment, and what are some of the people in our networks doing, and how are they trying to diversify their portfolios as well. But I think that there is something in that, when you get in touch with an investor, being able to have a conversation. What is it that you're looking for? What makes an investment exciting to you? Actually, can I connect you with this business owner? Because sometimes it works both ways, in that we can be connectors. So even if it's not for us, doesn't mean we can't connect people to other people. So apologies. I know we're close to lunch. I'm getting a side eye, even though earlier I was giving everyone else on stage a side eye, and I realise how horrible it is. So apologies, all the other speakers that have gone. So we're gonna run through. These are just, if you want to take a quick picture, these are just some of the questions that investors may ask compared to lenders. So it's just to think about the different mindsets that we're coming from. I guess my overarching communication on the difference on this is lenders, banks in particular, but lenders are really focused, they're really risk averse essentially, and their question is, we can give you this money, it's a lower interest rate, however, we kind of need to know that we are going to get all of our money back. Whereas an investor's mindset is more focused on, what is the return? How much is this business going to grow in the short, medium, long term? Well, probably short and medium term. What's my exit? And basically, how am I going to make loads of money off of the back of that? Again, depending on what your business is, it may make it more attractive, or to different types of funders, but ultimately these are just some of the things that when you're communicating, whether it's through a pitch or whether it's through an application, these are the different things you want to be thinking about when you're communicating to that particular type of person. Sorry, I'm going to rush through. This is just our, so as an organisation, we have an accelerator programme, which is for businesses that are that are established and looking to grow. We have a pitching model that we share. This is that pitching model, again, if you're speaking to investors, but also not just investors, if you're going to networking and want to connect with other business owners, if you're telling your family about how they can go out and be marketing ambassadors for you, because yes, we should be utilising our family and getting them to be our ambassadors, something I need to remember. But when speaking with investors, I think Nick kind of touched on it earlier, but one of the things I would really think about is understand what value they can bring to you and add to your business, because it isn't just about you making loads of money for them. It's also about what connections can they make for you, who can they introduce you to, how can they really help to make sure that your business is also a success and grows. And also remember, be prepared to negotiate. You don't have to accept the first offer. You don't even have to accept the offer. As Nick said, intuition is sometimes quite strong. And one of the things, I was at an event recently where someone was talking about the fact that they got investment in a business, and then unfortunately that relationship broke down. And someone said to me yesterday, working with investors is almost like being in a marriage. It is not an easy exit. You are not going to be able to just kind of cut ties and walk away. So it's something to really think about. If you are looking for investment, really make sure that you have that relationship and get to know that person in advance before you kind of, go down that path of, okay, I'm going to take your money and we're going to do this. Yes, it's exciting, but you just want to make sure that you are kind of protecting yourself, and do where you can get legal advice for that, because you want to make sure that if anything were to go wrong, you're going to be protected and you're walking away as best you can from that situation. And I've got 2 minutes. The final slide was just to give you a bit of an overview with other types of funding that you may want to consider or think about, because it isn't just about lending, it isn't just about investment. There are, well, I say that, and the first two are about lending, but there are different types of lending. So for startup loans, peer-to-peer lending are platforms where, again, it's individuals who want to invest but maybe lower amounts of money. Money is pooled, and these peer-to-peer lenders you're able to then borrow money from a peer-to-peer lender. They again they'll give you a risk profile and they'll give you a credit profile, and based on that will depend on how much money is able to be lent to you. But sometimes some people find peer-to-peer lenders a bit more flexible when they compare them to bank lending. Startup loans is a government-backed scheme. You can get an unsecured loan up to £25,000. It is based on your personal circumstances, so it's a personal loan to you, but it's a fixed interest rate of, I believe, 6.5%. And again, some people like to go down that route because they're more accessible, particularly in the startup phases, than other types. Grants, we all love free money. Fantastic, if your business is doing a particular thing or meeting a specific need. And one of the things with grants that needs to be considered is the application processes can be quite lengthy, but some of the growth hubs provide support with grant writing or application writing. And also, because of the nature of grants, they're not, again, always as easily accessible as other forms, but we have a grant finder called Swoop, and there's also an amazing individual based in Birmingham. I don't know if you can hear my accent, I'm actually from Birmingham, but amazing individual named Drew Curry, who creates a monthly newsletter that focuses on where there are pots of money and types of funding for different businesses. So I have a list of useful links that I will share with everybody who's attended today after this event, and one of the links is a link to his LinkedIn page. Crowdfunding is obviously a bit of a newer, more exciting type of funding that has become more popular over the years, but with crowdfunding it can be a really great marketing exercise, but you do have to do a lot of work in terms of getting the crowd, finding your crowd, creating the buzz before you even do the platform. And one thing to consider with crowdfunding is, in the last few years, they have been used sometimes for fraudulent activities, so it's just something to really consider and think about before you're going down that route. And then finally, social investment and impact investment is another form of funding that is becoming increasingly popular, particularly nowadays, where a lot more businesses, and particularly businesses that are women-owned and that are owned by people of colour, tend to want to solve social issues and solve social problems. One of the things to consider is it's not as popular as other types of funding, so there isn't necessarily as much funding in that sense. But if you do have a business that's going to be making a social impact, sometimes it's easier or better to talk with a social investor, because they are really focusing on the impact that you're having rather than can you pay the money back. That is me for now. I'm a minute over, so apologies, but we're about to head out for lunch. Dr. Carlton, did you want to come up? Or Nicola's here.